Welcome, Brian. Thank you for coming in today. We're very excited to have you with us.
Thank you for having me, Travis. I'm always happy to be in San Diego, my second home.
Fantastic. First, at Farmsfield Research, we'd like to say thank you for your service.
My pleasure. If I was young enough, I would do it all over again.
Now, Brian, can you tell us the Cliff Notes version of how you went from being a U.S. Navy SEAL to a trading professional?
Well, believe me, I didn't have this in the cards 30 years ago when I started out in the Navy, but because I always planned on being a Secret Service agent, when my Navy period was over. But I actually learned to trade right after the initial Gulf War in 1991, 1992. And in the spring of 1994, I happened to be reading a book by the author Larry Williams. And when I learned in the book that he actually resided here in San Diego County, I just had to look him up, especially being long 4 contracts or a whole lot of pounds of coffee. But we got talking and we became friends, and Larry's been a teacher, mentor, and friend to me to this day, and especially with my once political aspirations of not so recent.
So, of course, I'm very familiar with Larry Williams, and unless you've been living under a rock for the past 30 years, you know that Larry has in the past done many, many seminars and had the most popular and most successful trading futures newsletter of all time. Brian, do you implement the same methods that Larry's famous for, or have you developed a different trading style?
Well, Travis, there's a little bit of positive yes in both of those, but Larry teaches traders and up-and-coming traders the tools of trading, tools that he's developed himself, but very few, if any, get to learn his actual methods of what he is doing at a particular date and time. I have developed with Larry's tools that he taught me. I've learned just very few from a couple other fellows like Larry's friends, Tom DeMark and a couple others, but 95% of everything I've learned is indeed from Larry. So it is connecting the dots of Larry's tools that I have discovered for myself and put together as my own trading methodology and strategy. So I'm not doing exactly what Larry happens to be doing at this time, but everything that I am doing is from the toolbox that I learned personally from Larry.
Excellent. I see. Now, we have a lot to cover. Just so the audience knows, we are going to have a segment where Brian is going to be taking questions from the audience. You can type your questions in. We'll select a few to answer. Since we are limited on time, obviously we won't be able to answer everyone's questions, but Brian or someone from his team will follow up with you to make sure all of your questions are answered. Also, everyone who attended this afternoon will be getting a free copy of chapters 9 and 10 of our ebook, which will be covering the differences between investing and trading and also trading psychology. Brian, at this point, what we'd like to do is ask some questions that our followers want to know. And
Sure.
If we're missing some points, please feel free to bring them up, okay?
Okay.
Here we go. First and foremost, why agricultural futures?
Well, Travis, agricultural futures for a good reason. They are hard asset investments with tangible and or intrinsic value. These are items and products that we use in our everyday lives, be it food items, cotton, with the clothes that we're wearing, livestock, from the lunch we just had, lumber, rubber, or even grains. These items will always have demand and value. They'll never go away. Now, stocks and bonds, on the other hand, they're considered paper assets. There's so many moving parts to stocks and bonds that are controlled and can become easily out of control by human interaction. Theoretically, a company or a country can go bankrupt or insolvent overnight based on bad management decisions, and its stock or bond can plummet to zero, meaning it has no value whatsoever. I stated theoretically just a second ago. However, I do indeed have firsthand experience with this scenario actually playing out in real life on Halloween Day a couple years ago, back in 2011. Man Financial Global, or MF Global as you might know them, was once an upstanding financial investment firm that was involved with investing in paper assets on behalf of their shareholders and firm. But when their investment in other countries' bonds became more risky and their investment became unmanageable, they declared bankruptcy immediately and were out of business indefinitely with absolutely no forewarning. Travis, their stock went to zero, no value. For myself and my trading partners, agricultural futures have been a steady as we go trading investment vehicle that have little surprises. I plan my trades and I trade my plan. I do this 5 days a week, spanning over 3 decades now.
Now, in agricultural futures, is seasonality a big thing that affects your trading?
Travis, you bet it does. For me, that is a good part of stability for my trading methodology, as every agricultural trading market does indeed have a growing cycle. A growing cycle that is coordinated with the actual seasons and the weather itself. For example, in normal growing conditions, soft red wheat finds a high demand price in the beginning of the year and a low price in July following their harvest. I've got a chart of soft red wheat on a weekly basis, lined up for this first chart that we're going to talk about. I'd like to bring to the audience's attention in the middle part of my indicators here, this mustard dark yellow colored indicator is seasonality. And this seasonality for wheat goes back to 1968. And as you can see, the seasonality the trend for wheat was up going into this period. And when we go down to the seasonal tendency for wheat does indeed go up until the, this October timeframe, and it finds a high. And then between this high of the market and the seasonality, it goes down until the end of the year, ultimately right about here. And as you can see coming up the chart, wheat does indeed find a low there as well. But and then when we start the new year, wherever the prices of wheat were, that tends to be a high, and to leave the trade, sideways to down until the harvest period. We'll go over more of this in just a few minutes, but for corn or maize, it's just the opposite. The high demand price for corn or maize is in the June-July period, while the low supply price is found in December, just after its harvest. And let me bring up corn, just one click of the mouse here. And as you can see, the trend for corn had been up in this part of 2001 that we're looking at. And as you can see, there's a high right around this time of the year. And of course, the market did make a high this time. It went down until this low period here, right around the harvest time, the first week in October. And then it does a little bounce, which it did up here. But ultimately, it finds another low in December. And as you can see, there's another low right in here as well. And then it makes its way up or sideways, and then ultimately finding a high in this time period being the mid-July time period. And it looks like corn prices did indeed go up to their seasonal high for another 3 or 4 weeks, and then drifted back to their lows right around harvest time in October and ultimately in December. And yeah, right around here we find our low. And here we are off in 2013.
So there are usually 2 extreme price ranges at opposite times of the year, is that right?
Yes, it's definitely the growing cycle. that I mentioned. It's based off the cycles of the sun and the Earth's rotation. No rocket scientists here. They're predictable, and this predictability is a stable grounding force in my trading. The exciting part is when weather disrupts the growing cycle and the markets go crazy, and quite frankly, that's really what I live for in my chosen profession. Coming back to this corn cycle, you can see in the late June period, when prices should be finding a high and then a second high, it just really took off to the moon. And I believe this was based off of the unexpected drought last year. Is what this illustrates.
You know, of course, that looks like a very extreme trend happening there. Does your methodology have to adapt to different market conditions throughout the year?
Well, Travis, my original and unique trading plan has been engineered, if you will, to work with the markets under any circumstance in either upward or downward trends. Once a year, it's usually the week after Christmas and before New Year's, I research my proprietary trading signals. I apply to each of these markets I trade in order to see for myself how this past year's volatility has compared with all other previous years' volatility. If any adjustments are to be made with my trading strategy, then this is the time I make them for the forthcoming year, and I stick with it throughout the year with no adaptations interfering for current market and or temporary conditions. This requires absolute discipline, and it's discipline that the Navy SEAL teams have well prepared me for.
I'm sure. Now, one question that a lot of people want to know from professional traders is, why are you a trader as opposed to simply a long-term investor?
Okay, well, timing is everything. These past few years, long-term investors have learned for themselves everything they once learned about how they should be investing their money has been turned upside down. Quite literally, 401ks have turned into 201ks. Retirements were put on hold or canceled altogether, and a whole lot of younger generation investors realized there's a cycle to long-term investing, just as there is a cycle with trading agricultural futures. Being a futures trader puts my future and what is best for my future in my hands, not some high-dollar money manager's hands that doesn't know how to get out of a downward spiraling mutual fund situation, for example. Let me bring up a chart of something else I trade. How about live cattle? And, oh, this is weekly. Let me go ahead and shift to a daily. This is a daily example of live cattle or beef prices. And going back to this time frame, the trend had been up until right about here. And normally a mutual fund manager would hold whatever positions they have. This just happens to be cattle, but this could be Johnson & Johnson or Ford Motor Company or even Microsoft, and they would hold positions through this entire downtrend. Whereas a trend trader such as myself, we look for certain things in the charts that would lead us to believe that we're at the end of the trend. And if we have been making money on the upside of the market, then we need to get out and reevaluate these positions. Just by looking at this daily chart right here, it looks like I would be out somewhere in this time frame right in here, if you can see my mouse on your screen. But there is a trading strategy required for both long-term investing and trading, and I choose to trade my own nest egg based on my own long-term trading methodology.
I see. Now, are you a swing trader, a day trader? Are you a technical trader, a fundamental trader? What type of trader are you?
Sure. Well, I'll tell you right now, Travis, we can omit day trading from this bunch.
Okay.
I'm primarily a technical swing trader that specifically looks for getting the most out of each leg up or down in any market's trend. we're looking at live cattle here, and the trend for cattle is indeed down. And where I would be looking to get short somewhere right about in here, I'd say, let's call it 129.50. The market is currently at 121.55, so 121.50. You know, some people would get short and just hold through it, but I'm the type of person that looks to take advantage and exploit each leg. For example, the end of this leg ends, well, right about in this time frame, and then I would look to get short when the pullback upwards ends. I would look to be getting short in this area right in here and look to follow this leg down, maybe get out somewhere in here, maybe in here, look for a bounce up and look to get back short in here. This is really a short leg, and then get out again somewhere right in here, I'd say, and then look to get back short. But you see what I'm doing? It's kind of like a stair step. The market zigs and zags, zigs and zags, zigzag, etc. You know, I'm not a buy and hold guy. I am a trader. I get in, I get out. Each time I get out, it's an opportunity for me to reevaluate my positions. Since I post to the agfuturestrading.com blog each day, I do indeed follow some of the fundamental situation for each of the markets I trade, but my trading decisions each day are in, Travis, they're no way related to the news coming out on a particular day, that's for sure.
Is this because fundamental indicators tend to lag?
Yes, fundamental indicators, or external indicators as I call them, they do indeed lag. I look for internal indicators, and price for me and my trading methodology and strategies is the ultimate internal indicator.
I see. And what do you feel are the benefits or advantages to this type of trading?
Okay, well, the benefits to swing trading with the technical trend, it cannot be overlooked. In my view, and in my opinion only, Travis, it helps remove the emotion of trading and prevents me from locking into a position based on a conviction that a market is bound to move in any particular direction, either based on a fundamental report originated by the media or an official USDA report. It's when we get these convictions that the market is going to do this or going to do that, and then we're locked into that mindset, that really trips up a lot of traders. It tripped me up earlier in my trading days, but that's not what you know, I look for now. Let's take a look at another daily chart. I mentioned a moment ago the official USDA report, and every month they have these. Let's go on to something different. How about the grains? And we'll just take the most volatile grain, which is soybeans. And each month, again, there's a USDA report. And this month, I can see where it was right now. I'm going to go ahead and blow up my chart here and make it larger for the audience to see. Actually, I'll just bring it all the way out. The trend for soybeans had been up coming into the report on this day here. And on this day, Friday, March 8th, the market opened right near its high close in this leg up in its uptrend, but the market went immediately down, making lower lows. But just as soon as it went down in the same daily trading session, not only did it pop back up to where it opened, it broke out to make new highs. Ultimately, it settled right about where it opened for the day. But take a look. After the USDA report this day, the soybean market just rolled over back down. And in my work, Travis, the trend actually changed to down right here in this area. And this little pop-up that we have to this day, Monday, March 25th, I technically have soybeans in a downtrend until certain things happen to make the trend reverse itself. So the real benefit here is being in a position to capitalize on what the market will do next, not what I think the market will do next based off of fundamentals. If you think too much in this business, I have found, the markets will just pass us by. I want to be on board in whichever direction the market ultimately wants to go.
That sounds like a good strategy. Now, I know that you use some unique risk management and money management methods. Brian, can you talk a little bit about how you utilize options to assist in your trading methodology?
Sure. I actually wrote much literature on this subject 15 years ago. Too much information to get into great detail here, Travis, or really in depth in this limited forum. Basically, if we just trade futures or option contract instruments in and of themselves, meaning either enter into or exit out of, I refer to this type of trading as one-dimensional. Traders find when they use more instruments available to them, with their personal trading, their risk and margin can actually be lowered and possibly more profitable for them with their own unique risk temperament. For example, we've all heard of covered call writing.
Sure.
This is what I call a two-dimensional type of trading. When volatility in a particular market is high, writing call options against long future positions can be more profitable while lowering the risk. Let me show you again. We got a soybean chart up here. Let me go ahead and make this smaller. How do I zoom out here? Okay, got it. All right, so there's some pretty good zigzags in this soybean market. But for example, in this particular time frame, the trend of soybeans was up. Of course, we can't see the last month, when we're looking back in trading back in mid-January. So I think I have a new trend up. So when I look to get long soybeans, right somewhere in this area right here, I'm letting the market take me where it ultimately wants to go, but eventually it wants to have a retracement. So somewhere in this area that I'm circling here on my chart, I hope you can see it out there on your screen as well. But in this area, if I was utilizing the covered call option writing strategy, I'd be selling a call right in there. And Travis, do you know how low this market's going to retrace?
I would, but my crystal ball broke yesterday, unfortunately.
All right, well, none of us have crystal balls. So my mindset is that the trend for soybeans is indeed up. The market's going to have a dip, but I'm going to sell a covered call. And the market takes me, farther down than I would prefer, but I'm still holding on to that covered call option. And when I feel that the market has made its dip, and if I'm still bullish soybeans, I'm going to be looking to buy back the call option, hopefully at a profit. Right around in here is where I'd get my signal to go back long. And as long as the market's going up, I'm still holding my long futures. Hopefully, again, I bought back my call option for at least a nominal profit. But when the market takes off, and in this scenario, it makes a higher high, then somewhere down in here, I am looking to write the covered call option again, because I don't know, if this market is going to have an ultimate high here, or how far it's going to go down in a dip and continue its uptrend. But as a trader, I don't stick around with the position too long. My average time in a position is 4 days, but it's really, for me, it's all about exiting a position or covering or hedging my position. So I would write a covered call. The market makes its dip. I would look to buy back the covered call somewhere in here. The market stalls out, and somewhere in here, if I'm still bullish soybeans, I would look to sell the covered call or just exit the position altogether. But ultimately, that is what is going to happen, either exiting the position altogether or writing the covered call. But this would be a good example of two-dimensional type trading.
I see.
Travis. What I wrote about in the late 90s was trading when all three trading instruments, the futures contracts, the call options, the put options, all three were incorporated in one single trading strategy, or trading call and put options around a single futures position when that's utilized. This is how the professionals, like in the option trading pits that have been in this business for many years, this is how they make their living.
Do you use any other risk management tools in your trading that you'd like to talk about a little bit?
Well, sure. I measure volatility in each market I trade on a daily basis. If I determine the risk to be too intolerable in a market I plan on entering into, I'll sometimes alter to enter into this position on a pullback in order to lower the financial risk. This is by far not a perfect science, and I'm only able to do this about 1/2 of the time. But when it works out for me and I'm able to get in the market, then I win in two ways, Travis. First, by lowering the dollar risk if I'm wrong, and second, if I'm right about the market direction, then we have caught the market at an opportune time, and it just seems to be blue skies and green lights until the position is exited. Let me show you what I mean. Like, for instance, we were talking about buying the dips and selling the rallies. Well, the trend for soybeans was up at this time, and even though the market backed off, the trend was still up. And when the market made new lows and couldn't hold them this day, and especially this day, I would be looking to get back in the market. But on this particular day, if I got back in the market after the market made a bounce, sometimes I feel uncomfortable putting my stop just below the low. So I'll determine to be a buyer the next day, but I determine the market to open, come down and pick me up somewhere in here. And then, you know, I've lowered my risk, by the way. If I'm wrong about the market, I'll get stopped out for a less dollar amount than I normally would if I was wrong on this day. But in this day, I just happened to be right. You know, I planned for it. The market picked me up and would take me off. Would take off with me, I'm trying to say. So this is a way that I try to manage my risk as well. This risk management and my approach to it is directly proportional to the volatility of each market.
I see, letting the market dictate what you do rather than you trying to make the market adapt to your trading.
Exactly. You know, it's not necessarily I'm trying to beat the market to a pulp. I'm trying to work with and be cooperative of the market and planning to be on board with whichever, you know, the market does next. I don't want to try to guess or predict. I just want to, you know, I just want to go with the flow.
Very good. Now, this is a question that a lot of amateur traders have, and even some professional traders. And everybody is always very curious as to how others take the emotion out of trading. How do you do this?
Well, this is an important question because in order to be a successful trader, you must be able to control your emotions at all times. If a trader is unable to do this, then it is advisable to recognize this part of your risk temperament as early as possible in order to do something else.
Find another job.
Exactly. Actually, Travis, may I change the context of the question by changing the subject matter lightly?
By all means.
All right. So what if the question was, how do you take the emotion out of being a U.S. Navy SEAL? Because in order to be a successful Navy SEAL, you must also be able to control your emotions at all times. In the Navy, we studied our weapons, our demolitions, and tactics. In trading, I studied, and I continue to study, trading charts, technical analysis, and reoccurring patterns. In the Navy, we trained hard, not to the point where we got our standard operating procedures right, but rather we trained so diligently we couldn't get our procedures wrong. With trading, I have experimented with different entry and exit signals applied to different uptrend or downtrend scenarios. That I know, these signals take priority and precedence over others so that the market doesn't get much of any opportunity to catch me by surprise anymore. When and if a trader can reach this point, then there is little emotion in trading. And that's the absolute truth, Travis.
Now, Brian, have you ever found yourself fearful of the market after taking a few losses in a row?
Oh, without a doubt. I'm more concerned, however, how a few losses work on the psyche of my actual trading partners than myself. I have found the only way to get out of this scenario is to keep doing what it is I have been to break out to new equity highs. But I'd like to say one more thing, Travis. You take a few losses, you can't let it get to you. It's all charted in the equity curve, and in my equity curve, you may have seen we're either making new equity highs or we're in some type of drawdown, which I never know how long or how deep it's going to be, but I just do what I keep always doing to break out to new equity highs, like I just said.
Your technical trading strategy works, and so let it work.
Yes, exactly right.
And how do you stay disciplined in your trading when you know your strategy works and you feel like maybe you want to do something different, but how do you stay disciplined to stick with your own strategy?
The discipline is the absolute secret to maintaining success. For me, it is a matter of understanding the statistics behind my trading strategy. Each market I trade has its own history, Travis, so I know exactly how many trades my program has going back to the 60s or 70s, how many winning trades or how many losing trades, the biggest losing, the largest winning trade, the average size losing trade, the average size winning trade, the percentage of accuracy for each market. For example, let's look at a more volatile market. Oh, here's one right here, cotton. It's actually been trading pretty good. Let me apply my trading strategy. This is part of my trading strategy because some of the technology for these software engineers hasn't caught up to the real time. But here is the cotton market going back to December of 2012. It's been in a pretty good trading range, and with a click of the button, I can find out what the performance has been for cotton going back to 1973. This is almost 40 exact years, and in 40 exact years, there's been 1,340 trades. And before I even look at how much this market has made, I look at the profit factor, which is the number of wins divided by the number of losses. And this number happens to be 1.86. I've got my mouse pointing to it. And what this means, Travis, is for every losing trade cotton has on the average, there has been an average winning trade of 186% better. So by taking these 1,340 trades and dividing each trade by its the wins and losses, the average trade has just been over $200.
It's tremendous.
That's not bad. What that means is my trading strategy has more times than not, actually 186% times more not, wins versus losses. And each time I get into a trade, it's an average of just over $200, which includes commissions. I factor in my own commissions that I've negotiated with my broker in these factors as well. So, you can follow along with all of these trades that I make each day at the agfuturestrading.com website. You can see the trades there as they're entered into, maintained, and exited out of each day.
And so that's agfuturestrading.com, right, Brian?
Yes, that's it.
Right. Okay.
There's something else I should add, Travis. If a trader wants to be successful in the future, you must understand the history and the accuracy of the trading strategies past, just like I've presented here. If you, as a trader, are satisfied with it, then it can't be deviated from too much as the trading plays out. So my discipline really does revolve around planning the trades and trading my plan. Where have we heard this before, Travis?
As you will always tell us again and again, that's the way to do it.
Right.
Now, how do you keep from being greedy, Brian, when the market's just doing very, very well?
Okay, well, I don't necessarily avoid being greedy. There is a time and place for it in this business. I mentioned having a half dozen or so trading signals that I follow, some taking precedence over others. When other folks may be getting too greedy, thinking that their position in a market will just go to the moon, I, however, am looking for a way to get out with my less traded proprietary signals, one that I have to enter manually. But once out, I'm able to reevaluate the market under more favorable conditions and either look for a way back in or await a fresh trading signal altogether. Not too much surprises me anymore. It's always a matter of just following my trading strategy as best as humanly possible. One more thing I should mention at this point. Trading is not a race, nor is there a finish line per se. I have no need or burning desire to be in a market until the market conditions meet my criteria. Because if I just jump into a position outside of my trading realm or strategy, then I find myself participating in some other trader's game when I really prefer them to be in I prefer them to be a participant in my trading game plan. So
you're keeping your losses small while taking advantage of the larger trends, and as Scott says here on our chat, more appropriately stated, would be when to press the bet.
Yes, exactly. I've got this cotton trading chart up, and as you can see, my part of my trading plan in the light blue color here are entry points where I would enter into a cotton position or look to get long cotton if the risk temperament satisfies me. And then the red shows where I would get out. So we'd get out, look to get back in, ride the leg up, but when things don't look promising, look to get out, reevaluate the situation, look to get back in, doesn't always work out, let the market dip, look to get back in, another second in a row, small losing trade, let the market dip as far as it wants to go. I look to buy the dips, sell the rally, so we're buying the dip right in here, follow the leg up. Look, all I'm concerned with in all these trading days is looking for a way out, and it looks like I get out, but just as soon as I get back out, I'm looking for a way back in, and the market takes off on its next leg, and it's just looking for a way out. So this is a way to avoid the greed, is let the trading strategy work for itself. It's been developed and engineered by me for my conservative risk temperament. I just want to follow it, Travis, so that I'm, as one with my trading strategy.
I see. Now, when times are really good, do you ever find yourself over trading?
Not anymore, and not at all for the reasons I stated just previously. If anything, Travis, when times are really good, I am trying to get the most out of the position, getting in or out at projected daily highs or lows, depending on the direction I'm trading. This has been a positive adjustment to my trading method in terms of being more proactive with the trading strategy itself.
Fantastic. Okay, Brian, looks like we're at the time where we're going to take a couple of questions from the audience. Now, we've got some very technical questions here. What I'm going to do is I'm going to have you address those questions directly.
Sure.
However, one of the most common questions that has popped up here is about time frames. What kind of time frames, or do you use multiple time frames in your trading?
I do. I look at the weekly time frame. I trade according to the daily time frame, but I also look to get an idea for when I'm going to be entering into or getting out of positions by looking at the hourly time frame. So I look at all of those, Travis, and if you can imagine, if in this case we have the trend in cotton up, well, the weekly trend is also up. The daily trend is up. But right now you can see that the momentum cycle is currently down in cotton, and my weekly charts and my daily charts, they point up, but my hourly trend points down. And when the hourly trend is pointing down, Travis, I am looking to for ways to get into this market so I can resume trading with the overall trend on both the daily and weekly charts. So I hope that that covers the question that this fellow.
Certainly, I believe it does. We've got another question here from John S. in New York. Brian, are you a hands-on trader, or do you have a program that generates your trades kind of like a black box situation?
Oh, okay. No, the black box system is a blind faith type system, and with my background of studying the enemy, which in trading it's studying the charts, I do my own studies. I mostly have a mechanical system, but it must be maintained and supervised on a daily basis. I have to supervise my own trading because the trading for uptrends are different than trading for downtrends. So at the end of each day, I do indeed have to roll up my sleeves and take a look at the 13 or 14 different markets that I trade to determine how they needed to be traded tomorrow. There's no way that I could allow any black box system type program into my trading, because this is a trading strategy and methodology that I created, so I have to supervise it.
It's your baby, and you want to make sure it's on the right track at all times.
Exactly.
Great. Now, a number of questions have come up here regarding the new trading hours. Have they affected your trading at all?
Actually, Travis, they have affected my trading to the better, and here's why. I'm an agricultural futures trader. My trading is based mainly off of the grain markets. And ever since I started trading in the early 90s, the USDA monthly crop report came out right around the 8th day or the 10th day or so of the month. And the report came out during a 2-hour and 15-minute blackout period. And during this market blackout period, the USDA report was released, and if you were in a position, it was either going to be feast or famine for your trading account. Certainly. Because we weren't allowed to trade until the markets turned back on at the 8:30 Central Time time frame. And so now the market hours have changed. There's no more market blackout periods. And since they've changed that, they've also changed the time of the day when the monthly USDA report comes out. Instead of, 8:30 in the morning, New York time, it would come out, it now comes out at 12 noon, New York time. So, and the markets are on during that time. So, the computerized Globex trading has just been the benefit to us off-floor traders, as well as the trading hours and there's been a lot of changes, positive changes lately is what I'm getting at. So yeah, to answer John's question in New York City, that it's a whole lot better now because it's an even playing field. You know what I mean by that?
That makes sense.
Yeah,
certainly. So on that same vein, has the large shift of prop firms that are doing high frequency trading with computers and algorithms affected the way that you trade or had any adverse effect on your results?
Well, no. Actually, all these firms are doing is adding more liquidity and volatility to the marketplace. The way I see it, I view this as a positive addition in my trading evolution. Since all profits are based on trends, and I primarily hunt in perceived uptrends or downtrends, I think higher frequency trading tends to be to more exaggerate the moves of the market, and it's my business to exploit these moves to the best of my ability.
I see. Now we're running a little short on time, so we'll go to the audience for one more question. Just so everyone knows some of the more technical questions, we would love to hear from you at info@farnsfieldresearch.com. We will be sure to get back with you on the technical questions.
Hey, Travis, yes. I don't mean to interrupt, but that's kind of a mouthful, Farnsford. Can you spell it out real quick for the...
Certainly, absolutely. So that's going to be info, I-N-F-O, and then the @ sign, and then Farnsfield, which is F-A-R-N-S-F-I-E-L-D, research, R-E-S-E-A-R-C-H.com. And we will get back with anyone that sends questions, especially these technical questions that we unfortunately just don't have time to get into. However, we certainly will try to get into those during our next trader webinar. Okay. Brian, I really want to thank you for coming and spending some time with us this afternoon.
It's been my pleasure. I wish the audience all the best in future success.
Thanks, Brian. Again, Brian and his team will be following up with everyone in the audience to make sure all their questions were answered. Also, we'll be hosting these educational webinars on a regular basis with more traders that we've come across over the years in our research. Brian, I hope to have you back again as soon as I can. It's really been a treat.
I look forward to coming back to San Diego.
We will quickly point out the 2 chapters of our ebook that you will all be receiving. Chapter 9 goes over what we believe needs to be determined first. Do you know if you're an investor or a trader? Like many things in life, there are no hard, fast rules that delineate traders versus investors. In the ebook, we'll provide some guidelines as to how to disseminate the two. Second, what type of trading or investing fits your personality? Here are the 3 most common trading timeframes. Read the ebook to determine which one fits your personality, day, swing, or position trading. And finally, are you the type with his or her own ideas, or do you want to develop your own strategies? The ebook will provide you with some information on what you can do. Chapter 10 of our ebook is on trading psychology. This can play a huge part in your success or failure as an active trader or investor. All great traders have a crystal clear understanding of their psychological weaknesses. They also have an intimate knowledge about their emotional relationship with money. Money is neither good or bad, it simply magnifies what's inside you. This chapter will help you decide what type of trader or investor you want to become. Again, please email your questions to info@farnsfieldresearch.com, and we'll be more than happy to get back with you promptly. Well, that is it for now. I would like to thank you again, Brian, for coming in, and I hope to see everyone at the next webinar where we will cover a couple of other chapters. Have a great rest of your day, everyone, and prosperous trading to you.